In today's episode, we are joined by Lyn Alden, and we're going to be discussing what the heck is happening not only to our stock market, our economy, our global financial system, but how to make sense of it all and what's coming next. So, if you enjoyed today's episode, please make sure you hit the like button on this video to send it out in the YouTube universe. Comment down below Lyn Rules right there down below in the comments to help out the YouTube algo. And right there down below, we'll have Lyn's website. And last but not least, just a shout out to our sponsor today, which is First Majestic Silver, one of the purest, largest silver producing mining stocks out there in the world, with a great CEO, Keith Neumeyer. So thank you for being our sponsor today, First Majestic. And it's good to see you, Lyn.
Yeah, good to see you too. Happy to be back.
So I was just saying to you before, it's fun talking to you because we kind of every, I don't know, 3, 4, 5 months, we've kind of reconvened throughout the course of what's been taking place. And I want to get your assessment right now, because a lot of those things we're starting to see now, that inflation from the early money printing, you were pointing out they had printed such a tremendous amount of US dollars over the previous 12 months. We're starting to see some of that poking its head, talk about digital dollars. Still a lot of people without jobs. It seems like everywhere there's these help wanted signs. And I just wanted to get your assessment. What the heck's happening?
Well, right now, I think the most important way to think about it is in rate of change terms, and that's kind of the biggest disconnect that I think some people have, where you have to take into account both magnitudes and rate of change. So basically, last year, of course, we had this massive deflationary shock. You had a lot of demand destruction from lockdowns and the pandemic and things like that. So we printed a ton of money, and that's the combination of fiscal spending and then the Federal Reserve creating new base money to buy most of those bonds. And so that, unlike, for example, just doing QE alone, that money did not just stay in the banking system. It actually got out to people's bank accounts. It went out in the form of stimulus checks, unemployment benefits, PPP loans that turn into grants. In most cases, they get forgiven. Extra unemployment benefits, all these different kind of, policies went out. People got checks in their accounts. So, people's checking accounts, savings accounts went up. And so you had that kind of weird dislocation where fewer people are working, and yet their income's actually above trend for a period of time. And so, but for a while, they couldn't really spend it. They couldn't really travel anywhere. They couldn't do it a ton, right? So they mostly just saved it. They bought extra subscriptions and things like that, but they really didn't kind of circulate it too much. But then as things started to open up in later parts of 2020, and then especially here in 2021, we're seeing that money kind of pour back out into things. We're starting to see all sorts of, shortages from, people were off of work for a while. And then also there were kind of like weird demand dislocations, right? So more people bought homes all at once. And so we had lumber issues like sawmill bottlenecks. We had semiconductor shortages. We still have those taking place. We have shipping issues, right? So there's only so many container ships and containers out there. And you had kind of dislocations in shipping. And so when you have the combination of a lot of increase in broad money supply at the same time as there are really, real constraints on some of these supplies and services, goods and services, you start to get price inflation in some of those. And then in addition, we've seen start like kind of like wage inflation creeping up a little bit, partially because people have been given pretty big, benefits, whether they're working or not. And so basically, if you're a business that wants to lure people back to your workforce, you're in the position where you have to kind of do bigger sign-on bonuses or wage increases in order to kind of maintain that labor. So we've had some labor shortages, especially in kind of the service sector jobs. And but I think one of the things now is that we're experiencing a pretty high level of inflation. So official CPI hit 5% roughly this past month. And right at the peak where everyone's going to talk about inflation, what's probably going to happen actually is we're going to roll over a little bit because the base effects are a little bit harder as you go later into the summer, and some of those stimulus effects are kind of gradually wearing off. And so I think, as we look out later in this year, we're going to have above trend inflation, but this kind of May, June period might end up being kind of the local high watermark for at least for a period of time.
Do you then think this is a theme that's going to continue? When you say there may be a watermark, are you insinuating that that's temporary and we're entering a larger trajectory of this type of inflation? You've had the Fed saying basically, it's temporary, and then you've had many very bright people and many of the biggest investors in the world saying, I don't think so. Where do you fall on that scale maybe more down the line than say just May or June?
So one thing I do is I separate transitory and rate of change terms versus transitory and absolute terms. And that's kind of a piece that's kind of missing in this big dialogue of is it transitory? And what I mean by that is I like to use the 40s as an example, 1940s, because you had very fiscal driven inflation just like now. You had an external catalyst. It was a war instead of pandemics and shutdowns. But it was kind of actually a similar phenomenon in terms of where we were in the long term debt cycle, the type of politics that were happening at the time, kind of that populist versus establishment, change happening. And there's a lot of kind of similar factors. If you look at, say, the fourth turning, type of social analysis, it was the last time we were in a fourth turning. And basically, what we saw in the 40s, for example, is you would see these spikes of inflation, and then inflation would cool off, but it wouldn't deflate afterward, right? And so that'd be a permanent stepwise increase in broad prices. And that doesn't mean every single price goes up and stays there. For example, you could have a copper shortage, copper spikes and then cools off, right? But in general, broad prices went up to a higher level and then stayed there. And then they would stay there for a couple of years. And there'd be another big fiscal impulse, another big spike where changes and kind of, the wage and price controls. You'd have another big spike in inflation, and then that would cool off. It wouldn't really deflate afterwards. So you'd have another stepwise increase. And so my overall base case for the 2020s is we're looking something like that, where what we're experiencing now is mostly a stepwise increase in a number of prices. And there are some things that can and will come down from their peak. Like for example, in my main newsletter, I talked about lumber is, probably not going to stay as high as it was, and it's already in fact come down significantly. The question is, will it come all the way back down to its starting point? I don't think so. But even if that does, my base case is essentially that a broad enough section of prices, ranging from commodities to goods and services and wages, they might not keep accelerating the same pace they were, partially because of the year-over-year base effects get harder, and because some of that fiscal, that money that kind of injected into the economy starts to wear off. But that a lot of the price increases that we've seen, many of them will be permanent. And then the big question later on is, when that starts to cool off, if the economy starts to cool off, will fiscal policymakers pass another bill of some sort? Could be an infrastructure bill, could be something else, and that could give us another stepwise increase. But of course, we have to watch that policy outcome. And I think the other variable to watch longer term is energy markets. And because the past more than a decade, we've been in a period of commodity oversupply for the most part until this past year, we started to see some commodity shortages. But then, particularly in energy markets, that's where we've had the most abundance in terms of supply versus demand. And so, even last year and this year, we had, for example, a significant amount of OPEC spare capacity. But because prices have been low for a while, now they're starting to heat back up. But because energy prices have been low, and then especially also when you layer on ESG concerns and things like that, there's actually not a lot of capex going on in oil and gas. And so when you look out kind of a few years, the oil market looks a lot tighter. And so I wouldn't be surprised to see higher oil and gas prices when you look at a few years. And I think that is another catalyst to give us a later spike in the future.
So if you're looking at it from this type of fourth turning perspective, like you stated, one thing that I've noticed is it feels like people that could care less about a macroeconomics podcast, they're not interested. It seems like people that would normally never care about that, even they're noticing that things are increasing in price. I mean, it seems like everyone's noticing it. Television's talking about it. And then it's coupled with there's so many people without jobs, obviously. And then there's so many people that haven't paid their rent and their mortgages. And I wonder from that type of perspective, what are the ramifications when you've got now so many people that are dependent on this money coming in? And in many instances, it's maybe they don't even need it. They just want it. For example, at my favorite restaurant in town, they can't even get dishwashers. It's been 5, 6 months. It's a really nice restaurant, like a high-end nice restaurant. They serve with plastic stuff. Like you buy your nice wine in a plastic cup. And I made a joke to the manager and I said, too much stimulus money. And he said, yeah, no one will take our jobs. And I just wonder, what is the rent? Does the economy continue to hollow out while simultaneously the prices of everything continue to creep upwards? What do you think about that?
So yeah, what you would describe there would be a pretty stagflationary environment. So you'd have higher prices, but not a lot of GDP growth. So I think there's a couple kind of time periods to watch for this. So as you get into kind of the end of September, some of those programs start to wear off. We actually already have them wearing off in some states because they've noticed some of these issues, and so they've ended some of these extra benefit programs. But then nationwide, the federal money for that, last I checked, runs out in September, and so that could contribute again to the rate of change of inflation slowing down because suddenly, there are people that have less money to buy Dogecoin or whatever it was that they're buying, for example, meme stocks or meme coins, whatever their taste may be. But basically, we if you look at, for example, personal income on a national level, you kind of look at the long term trend is mostly a straight line. When you have a recession, normally you get a dip, but instead this time we actually went up. Personal income went up this period because they were given stimulus checks, extra unemployment benefits, things like that. And that doesn't mean every single person got more income. I mean, if someone, for example, lost like a $200,000 job, they didn't get compensated for that. But for example, the average or median person generally, either they kept working and also got stimulus checks, or they lost a job but they got replaced by that sort of income in addition to stimulus checks. And so whatever the case may be, on a national level, we had kind of a brief period of mildly above trend personal income, and so a lot of that found its way into speculative markets. And so this is not kind of without precedent. If you look at previous kind of early stages of inflation, at first, if you're given money and yet energy prices are still low as they were back, last year, and they can't really go anywhere, well, they take the money and they put it into the stock market or crypto markets, whatever the case may be. And some of those actually were good investments, but other ones, they're liable to come off after the enthusiasm's gone. And that's, I think, what we're seeing now is that because we don't have stimulus checks flowing out, because the employment benefits are starting to end, we have kind of less speculative mania in some of these markets. It's getting kind of a little bit more localized. And so I think as you look out further, the inflation could transform into energy price inflation and things like that. But even then, I don't think it'll be a straight line. There'll be periods where things cool off, and then that kind of jolts policymakers into likely another round of whatever they're going to do. But that also comes down to individual countries have different kind of political operations, right? So Europe has the issue where multiple countries together, they share a currency, and so there's more kind of bureaucracy when it comes to trying to do fiscal activities. So they tend to be more muted when it comes to fiscal spending. In the United States, we also have, for example, a very tight Senate, and so you have kind of that political gamesmanship there between what kind of programs they want to do, what kinds of things can get blocked, and so it ends up being kind of a political question to watch and to see how these different countries want to approach this.
Yeah, my personal who know we'll see how it plays out. My personal opinion is I can't foresee them stopping it because of the political ramifications of losing power. And I wonder, is this speculative mania that we're seeing? Is this a sign of the early stages of a currency crash, or is it just a small blimp in the road that eventually will be a distant memory?
I think that'll partially depend again on these kind of government decisions. And I agree. I mean, the general kind of incentive is towards more stimulus on their part, right? So few of them want to just stop the stimulus and then basically get voted out of office. Now, there's some dynamics there between, say, parties that are out of power can try to make that happen so they get back into power, and so you kind of have that cycling of politicians over time. So that's why I think those dynamics are worth watching. But overall, I mean, this in say crack up booms in previous kind of periods in history in different countries, they were often associated with kind of a speculative mania in the early stages of it. Now, how far this one extends, again, will partially depend on fiscal actions. But for example, if you look at, we've already had some degree of currency devaluation. So if you look back for the past 10 years, T-bills, for example, spent most of their time with negative real rates, meaning that inflation, even as officially measured by CPI, let alone the imperfections there, but CPI outpaced T-bill rates for the better part of the last 10 years. And then as you look kind of early this year, that hit a pretty wide gap, right? So T-bills are yielding basically zero. Same thing with bank accounts, and yet inflation is up to about 5%. And so if you're holding cash or cash equivalents, you're getting devalued, and so it's no wonder that people have gone into, say, precious metals, cryptos, meme stocks, and so even people that normally wouldn't be investors have played their hand at investing. And of course, it's become some of a social media, phenomenon of TikTok investors kind of sharing their best trades and all, a proliferation of people that are interested in macro because we're in this kind of unusual environment. And so that's kind of to be expected.
How far do you believe it can go? I mean, I sit and I wonder about it down the road, and I wonder, where does it go? There is, I believe, a vested interest in suppressing some level of the CPI, right? Because then you've got to readjust Social Security, all these types of things with the rate of inflation. So then I wonder, well, you look at Russia, all these different places where the empire was collapsing, the currencies, everyone's starting to realize the currency is worth less and less, but the government is continuing to say, hey guys, everything's fine. And then there's this stage that you get before basically, you know, uh, people lose the power system loses its power. And I wonder, are we headed in that trajectory where there is ultimately a lapse of faith in currency? You said part of it depends on the government's response, and I'm just curious, what's your personal opinion on how this really plays out?
And my overall opinion is that we're probably going to have more spikes of inflation like we saw this time. Like I said, I think energy markets will drive more of that later this decade. I think they probably will at some point pass an infrastructure bill before the midterms, but we could be surprised they might not. And so overall, my base case is to see an elevated period of inflation for the 2020s, and that it'll come in these kind of spikes rather than this kind of grinding inflation. So basically, what I've been kind of arguing is that a lot of people refer to the 70s when they think of inflation, but the 70s were very much loan driven. So banks were extending a lot of credit, and only towards the end of the decade did you start to see kind of significant fiscal deficits. But even then, they were actually pretty small as a percentage of global of national GDP compared to say the 40s or what we're experiencing now. And so in many ways, I point to the 40s as the closest approximation of what we have here, where it's very fiscal driven inflation, and it's at the end of a long term debt cycle, fourth turning type of phenomenon. Now, if you look at the 40s, for example, inflation averaged around 6%, but you had spikes, right? So it got as high as 20%, then it got as low as like -2% briefly. And so if you look at the whole average, it was somewhere around 6%. But interest rates were, roughly zero on the short end of the curve. They were capped at 2.5% on the long end of the curve. And so you got devalued in these kind of big devaluation pulses if you were holding cash or bonds. And so I think the 2020s, I think the magnitude is really kind of open for interpretation. I think that'll partially depend on how tight energy markets get, what some of the government decisions are. But I do think we're kind of in a similar pattern where we're going to have persistently negative real rates for most types of cash and bonds for most of the 2020s decade. And overall, I think the 2020s will be a higher average inflation level than say the 2010s decade by probably a pretty comfortable margin.
What do you make about the government digital currencies? Now, the United States and its minions have been discussing the necessity of digital dollar to compete with China. You know, there was at Bloomberg, many of those places covered China's, where it had essentially disposable time money and all these levels to it. What do you make of the central bank digital currencies, government digital currencies?
It's something to watch, and I view it mostly through a kind of concerned lens. Obviously, different states have different priorities with it. And so, China has been one of the countries that has spearheaded this, and of course, they like having a lot of top-down, state-driven authoritarianism, right? So they like to be able to surveil what their citizens are transacting in. They'd love to be able to block transactions. They have facial recognition cameras everywhere. So if there's a Wall Street Journal piece, for example, pointing out that you could do a thing where if someone jaywalks, they get caught on film and then their accounts automatically deducted with a fine. And that's a benign thing. I mean, there's obviously more dark routes they can go with that. And so I think that, China clearly is interested in going that route. I'm hoping that other countries kind of don't want to go down that path, but we are starting to see Europe and the Fed are basically also interested in central bank digital currencies. One way to think about that is that, right now under the current legal structure, central banks only have so much power. They can't give out grants to people, for example. They can only essentially change interest rates and buy or sell assets. And so that's why, for example, after the great financial crisis, we didn't see a really big increase in broad money supply because the Fed couldn't just hand out money to people. But so in 2020, what we had was a combination of fiscal authorities, basically handed out money to people, and the Fed's role was to finance it. And so you still had elected people making those decisions rather than the unelected people. And so there's basically checks and balances, even though people can argue about how much power each side should have, but in the current legal structure, there are some checks and balances on say what central bankers can do. Whereas if you say change the Federal Reserve Act, or if you change some of these laws, where central bankers can, put money directly into people's say Fed wallets or whatever, their central bank digital coins, they go around the banking system. That could, from their perspective, they like that because they have more tools to stimulate. If they want to, if there's a recession or if there's kind of um, deflation happening, they can basically inject money into people's wallets. They can make it time sensitive so it expires. They can have different interest rates for different groups if they want. But that obviously that's unelected people basically making what is essentially a fiscal decision at that point. And so that's one of those things I have trouble seeing something like that get through Congress, at least as currently constructed, because Congress would have to essentially cede some power to the central bank in order to have that kind of program in place. And so I think this will be something to watch. I think in the years ahead, the Fed is kind of behind the curve compared to China because the Fed is kind of at the heart of the current system, so they've had less incentive to kind of change over to a new system. Whereas China is specifically, they're trying to go around the SWIFT system as much as possible. They want to be able to buy commodities in their own currency. They're really big fans of the surveillance state, and so they've had a lot of incentive to kind of spearhead that. Where the Fed is I think a good thing, and it's kind of behind the curve in terms of enacting those types of policies, especially because they would need Congress to go along with it.
Interesting. I hadn't had somebody say that. I wonder if there's a way through national emergency to subvert it, i.e., economic crises. So that'll be interesting to watch. On the subject of commodities, um, did you see Paul Tudor Jones the other day on, was it on, and I think it was on NBC or might have been on NBC, where he was talking about commodities and he was essentially implying that so underfunded and, a potential for basically them to be squeezed, whether I think he referred directly to Reddit traders, but he also mentioned if big money gets in. What did you hear that? And what were your thoughts on that?
So I saw clips from that interview, and I generally agree with them. And so I do think that 2020's decade is going to be a decade for commodities compared to say the 2010s, which was a very for the most part a very bearish decade for commodities. And so that decade was characterized by oversupply and kind of weak demand. Whereas now with all the stimulus that are happening, there's higher demand, and we haven't done a lot of capex in many of these. And so I do think the 2020s are going to have tighter commodity markets, higher commodity prices, more pro-inflationary decade. I just don't think it'll come in waves. Basically, there'll be periods where it's happening, periods where it's not happening, and it'll be kind of these periods where inflationists will be happy, and then deflationists will be like, I told you so, and then there'll be like another round. For example, we have another kind of increase. And so overall, I agree with them that I think inflation is going to be elevated probably for longer than people think, just not necessarily in a straight line when you look at say the year-over-year rate of change.
Okay, so nonlinear then. So then as an investor in commodities, whatever they might be, and let's include gold and silver stocks in that equation as well. One of the difficulties is when it's moving nonlinear and you go through, as you said, a period where maybe it's a period of deflation or just not uh, ever growing inflation. It's easy to then think that the trend is over. So is this a hold for a decade, or trade and step in and out through the correction phases, or hold through?
I think it depends in part on someone's investing style. The way I'm approaching it is I kind of have a base commodity producer position, where I'm just kind of buying and holding a big chunk of commodity producers and certain commodities as well, ones that are like say gold and silver, and then around that kind of base position, I'm willing to add some chips to the table, take off chips to the table based on what happens with sentiment and overbought conditions. And so, for example, I was really bullish on copper in the mid 2020. But then we had, then it's, over the next, say 6 to 8 months, everybody was bullish on copper. It was like the most consensus thing in the world, and it went up pretty dramatically. Got overbought. Some of these copper stocks really exploded, and even though I think that they probably still have a longer runway ahead, I trimmed those positions because it just became a very consensus overbought trade. And so basically, my kind of approach here is to kind of rotate into whatever commodities are kind of out of favor, kind of build up positions, dollar cost average into positions when they're kind of weakened, and then kind of basically take a little bit of profits when they when they spike, when they go up pretty substantially when everybody wants them.
What's what's your favorite commodities?
I mean, say longer term for the decade, I definitely like oil and gas. That's one of the least consensus ones. I mean, there's pretty big consensus that oil and gas would have a bounce, but the kind of the consensus is that electrical vehicles are going to come in and just fossil fuels are not going to be needed anymore. But if you look at, for example, long-term history, whenever we add new energy sources, so far we don't really replace old energy sources. We just add on to them. And so, I think, for example, oil and gas could decrease as a percentage of our global energy share, but they're unlikely to decrease in absolute terms. And when you combine that with the fact that there's not a lot of new capex happening in most of the oil and gas markets, um, I do think that we could have some tightness as you look out later into the decade. And so I do like some of the transporters or the producers, but specifically I like the conservative ones. So the ones where they have strong balance sheets, low cost production, and so they can get through the bear markets no problem, and then also generally enjoy upside from the bull markets. Beyond that, I like again, it won't be a straight line, but I like uranium markets. Most people in that niche market are aware of kind of long-term supply deficits there, and so I think uranium's
So,
pretty.
what's your thoughts on uranium's? One of our most commonly discussed, and one of my places I'm personally heavy invested in, and wondering what's your thoughts on the recent development then with Sprott Uranium Trust going on the New York Stock Exchange, probably in Q3. Of course, you discuss the supply demand issue. Then also, we're seeing all these countries talking about reducing carbon, and everybody's now saying nuclear. And then also Shamath, did you see his clip the other day where Shamath said on his podcast that there's somebody introduced him to uranium and there's a huge play? So just wondering your thoughts on all that.
Yeah, I mean, so I really did a lot of the research last year, and so by October 2020, I became bullish on uranium. I wrote about it, and I continue to be. I mean, it's one of those things. It got pretty hot for a little bit, and so it's kind of like it's a little bit less exciting than when I wrote about it in say October 2020. But I do think it's a multi-year play, and so even though it can cool off for say 6 months at a time, I think that uranium and uranium stocks are likely to do pretty well, as we head deeper into the 2020s decade. And so talking about like say carbon targets, for example, I think it was recently reported that Japan's not going to meet some of their carbon targets. It's like, well, I mean, you shut off a lot of the nuclear reactors and kind of brought them on pretty slowly, and so we understand that there are safety concerns there. But basically, if you look at say countries wanted to meet those targets, basically nuclear energy is one of the ways that they can do those targets if they want to. And so it's not surprising that the narrative used to be kind of anti-nuclear and it's kind of increasingly warming towards nuclear because it's one of the energy sources that makes sense on a kind of a risk, kind of a risk reward basis. Especially, if you look at a lot of those nuclear disasters, those were literally 1960s and 1970s technology, right? So even the 2011 Fukushima disaster, that's like a 1970s reactor that went bad. And so I think it's basically not been an era that we put a lot of development in that we probably should have. I'm hopeful that as they go forward, they'll be able to put more capital into that market to basically make cheaper, safer reactors over time. And so I do think that's probably a pretty important part of energy mix, especially when you look at say Asia, like China and India. People when they think of nuclear, they often think of the Western world, and they're like, well, aren't we kind of not building more? Aren't we kind of shutting them down? And it's like, well, not we're not really building too many more, but we're extending their lifetimes pretty long in most cases. And when you look at China and India and South Korea and Eastern Europe, I mean, they're still building reactors. And so, for example, if you look in India, for example, their cities have some of the dirtiest air pollution in the world, and it's because a lot of it's still coal based, right? So it's not surprising that a lot of them would want to, add some nuclear to their mix, because it's one way to get more energy without adding more and more, kind of coal to the air. And so they actually still have growing coal usage, and they want to kind of, taper that off and kind of level that out and replace some of that with nuclear over time. And so I think nuclear has a pretty bullish outlook. And then when you add things like Sprott, I mean that can be it's tricky in the near term because the fund was trading at a premium over NAV, and so that could arbitrage some of that away. But longer term, that's like another way that whenever there's a lot of interest in that fund, they can issue new shares and basically buy more uranium, and it's kind of like a big sink to take uranium out of the market. And so I think that's a pretty bullish development. And Sprott's obviously a really good company.
So, how about gold and silver long term? Still, silver still hasn't been able to break above 30. Gold hasn't been able to revisit 2000 plus. Um, and it seems like the majority of the macroeconomic factors, uh, you would think would favor it. You've talked about real rates. Give us your thoughts on gold and silver and how you think they'll fare moving forward.
I'm still long-term bullish on them. It depends. Again, I think they're going to come in cycles. And so if you look at gold, for example, gold, real rates as measured by the 10-year treasury minus inflation break-evens, which is like the tips markets, kind of forward inflation expectation, which isn't even a great measurement because the Fed's buying tips, right? So when the measurement become when like the measurement becomes a target, it ceases to be a measurement is the example. But that's they're all paper markets. So the gold paper market follows the inflation paper market. And so basically when you look at say 10-year treasuries minus the 10-year break evens, that's the real yield that the gold market has the closest correlation to. And for example, that hit a low back in August 2020, and it's started to rise, and then it kind of rolled back over, and so it's kind of come back down, but it's never really gotten to lower lows yet. And so because we've had inflation break evens rise, we had nominal yields rise as well, and so we've been in this kind of choppy pattern for gold, which makes sense when you look at the real rates argument. And so over time, I think the 2020s are likely to be in a period of persistently negative real rates. I do think we'll probably see a period where we go into lower negative rate territory than we saw in August 2020. I just don't know if that'll be in say this year or not. But I do think as you look out further, that's certainly a place I'd want to have some of my assets in gold and gold miners, and probably silver as well, because you're still looking at a period of cash devaluation, bond devaluation, and so I think those are nice hedges. In addition, if you look at say gold and silver miners, they're actually pretty attractive with current gold and silver prices. And so even if you're kind of lukewarm on the underlying metal, and you think, okay, let's say gold and silver go flat and choppy for a year or so, those miners in many cases are making pretty good free cash flow at current levels, and they're not too expensive on a price to free cash flow basis. And a lot of them have plowed that free cash flow instead of, if you look back in 2011, a lot of them were whatever money they had, they would just spend it in more capex or they'd make acquisitions. And a lot of them didn't really produce a lot of free cash flow, even though they had really strong markets in their underlying metal. And now what they're doing is they're basically just all the profits that they're getting from those higher prices, they're paying off debt, they're strengthening their balance sheet. Some of them are paying dividends to shareholders. And so in many ways, the gold and silver stocks have better balance sheets and better free cash flow than they've had in, modern history.
So, let's talk a little bit about your some of your other philosophies you've really been able to really establish and build your business, your brand. You also think very critically about the problems that are happening in the world, and one of the things that I like to do on this show, as you know, is not just talk about macro or just talk about investing, because if we are in this fourth turning time and we are in this time of social instability, and there are a lot of people that, as you said, some people's income has went up. A lot of people though are greatly struggling, whether it be financially or just dealing emotionally with the rate of change, as you termed it. What are important philosophies you think to succeed, create your freedom over the next decade?
I think, focusing on self improvement is a really big thing to do, I think. And so a lot of people try to find happiness from external factors. And it's one of those things where to some extent external factors are obviously really helpful. You want to feel secure, you want to know where your next rent check is coming from, your next mortgage payment, people want to have stability. And so basically, if you look at what types spending money on certain types of areas generally reliably produces more happiness than other types of areas. And so basically, saving money in order to have a good financial foundation is really important. There's little things like, trying to minimize your commute or even, working digitally if you can, things like investing in a quality mattress. I mean, it's funny enough. I mean, basically it's little things like that improve quality of life more than say trying to show others that you have wealth or basically, kind of in that rat race of kind of, always thinking that if you only had this item, you'll be happier or kind of using, relying on external needs. Whereas I think kind of, focusing on good nutrition, good exercise, good relationships, and then money in targeted areas of whatever your interest happens to be. Maybe it's music, maybe it's classic cars. People have their own tastes, obviously, but basically focusing on certain areas that actually bring you happiness, and then mostly trying to diversify your income streams, spend less than you earn, and really kind of put that money into investments and put that money into ways to make it so that you're more flexible and you have more freedom, so that when things go wrong, if they go wrong, you basically have a low kind of fixed expense base, rather than kind of always kind of living as kind of high in your means as possible. I think that's kind of the way one of the ways to approach is really just kind of focus on that on internal happiness rather than material happiness, and just to use that money, where you can.
So you talked about the rat race. Before lockdowns happened, I forget about maybe 75% of people were living paycheck to paycheck. There's all types of course, incredible data on the amount of assets the average American dies with, which is virtually none. Um, and then there's things like the Gallup polls stating that nearly three quarters of people are quote actively disengaged from their jobs, and then we become a nation that basically is built into servitude through debt. And so for most people, the majority of their lives, they're basically stuck within what I guess I would call you define that I guess as the rat race. And I want to know what you think is the most important advice or steps to take to break out of that, to break out of that loop or that servitude loop that it seems like our society conditions us to become a part of.
So one is, kind of what I just said of basically, when it comes to consumption, basically kind of conscious consumption, basically reduce consumption of things that don't really bring you happiness, but obviously still consume things that do. Now, when it comes to say getting out of the rat race and income production, that obviously, it's challenging for different people because they all start with different circumstances, different paths in life. From my own experience, for example, I went through this a decade ago because I was in college during the great financial crisis, and my background is I came from a trailer park before college, and so we didn't have a lot of money. I had to go into student debt in order to get through college, and I worked through college to basically mitigate that where I could. And then as I was getting ready to leave college, I was like, I gotta kickstart this more than just say an entry level engineer salary because that's what I was studying at the time, engineering. I was going into engineering, and so rather than just do my engineering job to pay that off, I also started, just basically applying a skill that I was good at, which was building websites and basically making income from that. And basically using that to kind of snowball the debt payoff and start building up assets at a quicker rate. And so basically what I kind of did was I front loaded my work a little bit. And so, I worked maybe harder than ideally, because I had a full-time job and also side gigs. But because I was doing things I enjoyed, in many cases, my hobbies were also income producing, and so it kind of just trained myself to like work more and to basically get satisfaction from that work, so that I could build up kind of a financial freedom at an earlier pace rather than something that maybe would have taken decades took 1 decade to kind of build that up over time. And so I basically would recommend people look into that and basically finding things that they enjoy that might help them accelerate their financial growth. And so one way I like to put it is, let's say, for example, someone makes $50,000 and their expenses are $40,000. They can save $10,000. Now, if they can find a way just to boost their income by 20%, right? So they make 60,000 instead of 50,000, but then they don't increase their expenses at all. Even though that was only a 20% increase in their income, that's a 100% increase in their savings rate, right? Because instead of saving 10, they can save 20,000. And so that's one of the ways I looked at it is, for every incremental income growth you can get, if you keep your expenses the same, that goes down to the bottom line, helps you start that wealth building snowball. And so I think that's one of the ways to look at it. You can kind of do like an audit of how you spend your time and kind of look at the percentage of say consumption versus production and say like how much time do I spend watching TV or just kind of doing things that might not serve me super well, and say, okay, can I shift more of that towards production, if possible, and basically kind of go along that route. But obviously it's not an easy thing, and because of certain policies in place, it is a challenging thing for a lot of people. And I think it in some ways it's harder than it was decades ago. But then due to technologies, due to the internet, for example, that also makes it easier. So it's kind of that kind of a balance there.
So essentially, building additional sources of income. You're saying like if you make 50, sure, figure out ways to maximize it, but instead of just focusing on constriction, see if you can develop additional sources of income that can help expedite that rate of change, rate of growth.
Exactly. Yeah. Yeah. Most people have an expertise in something, and that you're passionate about and that you enjoy doing. And so, if you can find a way to share that with other people, or have some sort of side business or side job that you enjoy doing, then yeah, basically the percent that adds to your income that might not be too high, but along with say discipline, your expenses being fixed, that can actually increase your savings rate by 50 or 100%, depending on what your exact numbers are.
Uh, do you feel like let me ask you this. So you said you were living in a trailer park. This wasn't exactly something, none of us are really taught is if thinking about it becoming a producer, developing additional sources of income. You go from there. You said you took on a bunch of debt. You worked through it. Now you've got a very successful online business and company. And I want to know what you think the most important part of that process to go from where you were to be able to get to this position, strategy, philosophically, mindset wise, to be able to, they say what, 90% of businesses fail in the first, small businesses fail in the first 10 years. Well, what separated you in that process and what's been important for you?
So that's a challenging. So I guess at the risk of being redundant, I would say basically one is that I had kind of a minimalist lifestyle starting out, and in many ways I still do. But basically, it's one of those things. If you look up even the statistics of how much happier you can be, just make sure you get proper exercise, right? So, if someone's going to spend their money on something, exercise is in most cases free or super cheap, and that is a way to kind of it clears your mind. It makes you happy, and it's a way to basically get more fulfillment without spending more money. And so things like that, where basically one is I just kind of cultivated a bit of kind of a mindset of not needing to spend money to be happy. That's kind of the first thing. And then from there, I just was kind of honest with myself and find things that I was passionate on that I wouldn't mind working hard at. And so, for example, when I was building a website or when I was kind of running my website and then kind of writing content, doing financial research, for whatever reason, that's just super enjoyable to me, right? So for example, I often use the description like when I was a kid, I was kind of like learning how to play guitar, and I just had no passion for it. I couldn't I wasn't I just haven't didn't have a knack for it, and no matter how much I practiced, I wasn't getting good very quickly, and just kind of my dad always wanted me to keep it up, and but it's just kind of an effort. Every time I did it was an effort, and so that's basically was kind of recognizing that's just not the way I want to keep going because for whatever reason it's not clicking with me. Whereas other things I can spend 5 hours doing something and it felt like 1 hour because I was so into it, and therefore I get good at it because I like doing it, and I'm willing to put in the effort without thinking about it, which for me is things like finance or things like exercise, nutrition. There's certain areas that I just whatever reason have a knack at or an interest in, and then therefore I kind of start that flywheel. And so I think that people have to be kind of really honest about what are they good at? What are they bad at? And more importantly, what do they enjoy doing enough to get good at? And then when they get good enough at something, then they can kind of monetize that in some way and just kind of help themselves have additional income streams. And then depending on what they choose, I mean that could blossom to a full business and basically exceed whatever full time income they had from another source. But the point is to basically kind of just try it in any way they can to take income into their own hands.
Awesome. Really appreciate that, Lyn. So we're going to put Lyn's website right there down below in the description. Make sure you hit the like button on this video to send it out in the YouTube universe so more people see it. Give us a comment down below if you didn't yet. Lyn rules right there down below. Let us know one thing that you learned from today's episode. And Lyn, I want to thank you for coming on.
Yep. Thanks so much for having me. Hopefully it was helpful to people.